So hitting on the top three things, number one, deflation. Just in Europe today, both on a reported basis and in real-time market pricing terms, we're continuing to see both disinflation and deflation. And so if you think about the Spanish CPI for December is down 1.1% year over year versus minus 40 basis points in November. And then the Italian PPI came out as well. That was down 1.2% year over year. That's something we think is likely coming to a U.S. economy near you over the intermediate term, and we continue to see that in the real-time market pricing. With oil down this morning, Russia's down 2.3%. The CRB index is crashing to year-to-date lows. Stuff is all very obvious now. We've been making this quad pro call for quite some time now, so to the extent you're on this call this morning, we don't think we need to reiterate that. Number two, utilities. Obviously, when you have global growth slowing and deflation or disinflation at the same time, you should allocate capital to bonds, and it looks like a bond in the equity market. And no surprise here, we see utilities led gainers yesterday, up 1.2% on the day to a monster 29.3% year to date. That's obviously crushing anything that looks like inflation or sort of accelerating growth. And then lastly, volume. This is something we've been hitting on since April. The total U.S. equity market volume, including the dark pool, at the all-time closing high was minus 14% versus its one-month average and minus 33% versus its year-to-date average. So again, you're starting to get some what we think is a illiquidity setup in stocks. It's very similar to the end of September and very similar to the end of November before those respective 10% and 5% corrections in early October and December. So in size, we think it's more appropriate to be long the TLT, which is the long-term treasury bonds versus the SPY here. So to the extent you allocating marketable capital, that's what we think you should be doing here as we progress into the new year.